John Higgins, Mortgage One. Happy Tuesday. Hope everyone enjoyed the long Labor Day weekend. Got to spend a little bit of time with your family, I hope. So let's take a look at where we're at as far as interest rates go. We mentioned in the last week's update that a lot of big numbers coming out this past week. Basically the fixture of last week's numbers was on Friday, the jobs number, and that really kind of came in basically in line with what the market was expecting. Some backward revisions that took some jobs out of the total mix. So as far as what the Fed is looking for, last week's numbers all really kind of were positive with respect to interest rates. And we did see a bit of moderation in our interest rates as the week progressed, which was good news. But the way this market has been shaping up week after week, Friday was kind of a messy day with regard to rates. So we saw price bouncing all around, up and down. In the end, we ended up with slightly higher interest rates on Friday, and there's been a little follow through this morning with regard to rates, and we're off even the closing numbers on Friday. So rates still trying to tick higher, and I've given you a little bit of a peek at where this market is, and we've talked about inflation being such a key factor with regard to our interest rates, and the Fed has done everything they can by raising rates to try to tamp down inflation, and it's really working. If we look at the year-over-year change on this graph, you're seeing a number that got close to 9.5% a year ago, and now some of the numbers, depending on how you look at it, if you look at core or the headline number as far as consumer price index goes, we're down close to 3%. So, that's a huge rollback in a year, and obviously higher interest rates seem to have made a difference there. Yet, if you look at the 10-year Treasury, we're right back to where we were a year ago. Coming into the fall, we saw interest rates rising and hitting a peak in late October and November. We've made progress at various times on rates. We've seen the 10-year Treasury get down below 3.5% earlier this year, and we've bounced all the way back up to the highs that we saw last fall, and we're at 4.25% today on the 10-year Treasury, keeping our mortgage rates at or above 7% right now. It's been very challenging with a number of cross currents that are out there between oil recently starting to spike. Might be heading to $90 a barrel, and that would be very inflationary. We see the rest of the world having issues with inflation, where ours has rolled down nicely from their peak down to the 3 to 4% range. All of a sudden, the rest of the world is still grappling with this and raising rates, and our Fed is trying to keep inflation down here in the States, but you have to be cognizant of what's going on around the world, and it's been a very stubborn interest rate environment. So don't know if the Fed is going to raise rates any more this year. As we look at some of the forward forecasting on where the Fed may or may not be in the next couple meetings, it looks like they're going to be on pause here. Certainly the next meeting, there's only, I think, a 1 in 5 chance that they raise rates. And then in the following, and I believe the last meeting of the year, 50-50 coin flip basically for rates increase on the Fed side. But with all of that in the forecast, our rates, hitting higher highs here for the last number of months, and that's not good for housing. We look at affordability. This interest rate market has really gutted home buyers' affordability. It hasn't really slowed the buyers' interest. They're out there. There's just not enough homes for sale at the moment to take care of the demand, and that's why we continue to see home prices go up. So we'll give you an update next week. We'll see how the market continues to digest some of these numbers, kind of try to forecast what the Fed may be doing in the long term, but it does not look like interest rates get much better anytime soon, and probably will be stubbornly above this 7% number that we see today. Talk to you next week.